Let's bring on board Vineet Bhatnagar, MD at Phillip Capital. He joins us on the show. Vineet, hi, morning. A rough patch the market's gotten itself into. How are you feeling about how far or deep this correction could get?
We are actually anticipating the correction to not go beyond 58.60 or 58.50. And one of the reasons why we are basing this to be a strong support is primarily the contrarian indicator, which is the capitalization index that we track internally, and that is showing a spiking as we speak. It was actually showing a high reading even yesterday. But if it were to, if the index were to move down and close at around 58.50 or 58.60, that would have perhaps given it sufficient strength to bounce back. So that's the support we are looking at.
And what do you think is going to take the Nifty higher?
I guess it is going to be, some kind of a lifting off for all the heavyweights. I guess the primary one should be Bank Nifty, and that's the one that we are looking at more importantly. Mind you, on the back of the results, SBI did show a negative price movement, which was clearly unhealthy. But our understanding is that there should be a lift off after 58.50, 58.60. However, I must also add that in the last 3 trading sessions alone, which is from the expiry last week on only Friday, Monday and Tuesday, FIIs have taken a cumulative negative position in the index futures to the extent of about $600 million. On Thursday, when the expiry happened, it was a long of about 1.4 billion. So there is still a net long of about $800 million. But the speed with which they have added on the negative side of index future in 3 trading sessions is something that I wanted to highlight.
Vineet, quality private banks or quality financial stocks have corrected 5 to 8% in quick time. Is it a good time to revisit HDFC Bank, ICICI Bank, Axis Bank stocks which everyone always wanted to buy, but because of sheer price appreciation, no one got the opportunity?
I would be inclined to indeed look at accumulating some of these names that you mentioned. I, for one, have always been quite vocal about creating a portfolio with some of these private sector banks with a 2-year horizon. And you are right that in between the movement that happened was quite intimidating in terms of holding out the conviction to keep buying at higher levels. Now that the price has contracted for even names like Axis Bank, I think it makes sense for portfolio holders to add some of these names. ICICI Bank, HDFC Bank and Axis Bank will be the names that I would add.
Vineet, it's quite ironical. If I look at the consensus on the street, is that Indian economy has bottomed out, GDP has bottomed out, and growth will only pick up. That is the consensus view. But if I look at the market performance this year, markets have done nothing special. In dollar terms, we are negative, and currency also has plunged at 11-month low.
I think it's a combination of two phenomena. One is that while the actual data or all the actual pickup in the economy would be visible a few quarters away, and therefore the commentary from the experts or the economists of the current numbers being perhaps closer to the bottom is always a lag effect, and therefore for market which always move up or down in anticipation could still happen. So it is very difficult to say that now that the consensus view has started forming on the positive, there is no reason for market not to move down as a part of a technical correction. We still believe that the downside for the market hereafter should remain limited, and therefore we are trying to come up with a consistent view of not only a short-term technical correction but also also a good likelihood of market or economy actually moving upwards in the second half of this particular calendar year. And the second point is obviously, the headwinds that one sees on account of external factors, whether it be the U.S. demand or the U.S. Fed making commentary about the monetary easing being a thing of the past, and how soon it will come about, and how it affects the liquidity into the emerging market, is always a headwind that all markets like India would have to be challenged with.
Vineet, how are you approaching the pharma space now, and do you think the run-up is far from over when it comes to names like a Dr. Reddy's or Sun Pharma, or should one start taking off profits bit by bit?
I think as a sector, it benefits from the defensive nature and the appeal of that particular sector, as across the board, all stocks moving up when the market as a whole is looking negative. We would of course prescribe to be selective in terms of what one should hold if one is actually looking at including them as a part of your portfolio. Profit booking for short-term traders perhaps could be on cards, which could be timed better with the bottoming of Nifty, and therefore if these stocks were to keep moving higher and Nifty were to move to 5850, 5860, that's the time one could book profits. But the portfolio holders could look at adding actually names like Kanhaiya and Lupin to their holdings.
Why do you like Kanhaiya and why do you like Lupin? One-line answer on each.
I guess Kanhaiya and Lupin has been, our strong calls fundamentally, primarily on account of the earning forecast that analysts have done here internally for both FY14 as well as FY15. So those are the two names that we have actually been sticking out with for a month or so.
Kanhaiya came out with horrible numbers. In fact, they have one of the lowest margins in the industry. So I'm trying to understand from you is that why are you tilting towards Kanhaiya?
I guess Kanhaiya is something that is showing a more consistent growth pattern or earnings. The expansion of the PE is also something that one would like to keep in mind. The large cap ones have either shown momentum or are not showing the consistent earning growth that one is looking at. So the PEG is something that is one of the key factors for our analysts to look at Kanhaiya.